Hi, this is Drew Tignanelli, President of the Financial Consulate. We're here for our October update.
Do you think it's important that people know who I am, Drew?
Yes, you are Timothy J. Maurer.
Some call me that. So, Drew, we got a lot of stuff going on right now, and one of the big things is QE. What was it, 17, 18? How many times have we done this now? What's going on, and what impact's it going to have?
QE3.
3.
And they call it quantitative easing.
Mm-hmm.
So, in essence, what happens is, and this is, they're saying this is quantitative easing to infinity.
Right.
So, in other
They
words,
didn't set a limit on it, right?
He didn't say, I'm going to buy $300 billion of bonds or something like that, like he did in 1 and 2. He just said, I'm going to buy $40 billion a month until it starts to make things
Until it's better.
Get better and so forth. And the problem is quantitative easing has really no impact. It's a great concept, but it's kind of foolish, and it hasn't worked, and it's not going to work, and it's logical why it's not going to work.
Why is that?
Let's take a look at this. So basically what happens is the Federal Reserve can literally create dollars out of nowhere.
Okay.
They
People
just
call it printing money.
Well, they do.
Is it similar?
It is printing money. Because they take money out of nowhere and they buy bonds in the marketplace.
Okay.
So they go out and they buy U.S. Treasury bonds, or in this case, he's going to buy mortgage-backed securities. So he's going to buy your mortgage, he's going to buy my mortgage.
He can have my mortgage if he wants.
Hopefully he can get it at a lower interest rate for us, too.
Yeah.
And that's what his objective is, so we'll get to that later. So he's taking money out of nowhere, he's going out and he's buying bonds, and he's stuffing them into the bank vault of the Federal Reserve Bank, okay? And so he's created this new money, and he's taken bonds out of the marketplace. So technically, the economy has the same amount of money as it had before from a valuation point of view, but now it's cash, and the bonds are held by him.
Right.
And now this cash is sitting in the bank's reserves, and they're now to take those reserves and they're to lend them to people. Mm-hmm. And so they'll come to me and say, hey, do you want a business loan? Hey, do you want a home equity loan? They'll come to different other clients and they'll say, hey, do you want to? And that loaning of money is what stimulates economic activity. Mm-hmm. And so when I borrow money and I ramp my business up more, I'm going to hire more people, and I'm going to pay them salaries, and they're going to take it and they're going to buy other things, and then those businesses, they buy things, and you can see how that's what they're looking for, okay? So now watch what happens. The Federal Reserve does this, and they have spent $2 trillion and bought $2 trillion worth of bonds. Mm-hmm. And during that same period of time that they bought $2 trillion worth of bonds, the banks who have received that money have taken $1.7 trillion of reserve cash and put it on deposit with the Federal Reserve. Now, what that means is that they've literally taken the cash they now got from Bernanke and them buying the bonds from them and put it back into the Federal Reserve and say, we don't have anywhere to lend this, and it's better to get 0.25% from you than to have it sitting in our bank vaults and making nothing. And so they created $2 trillion, and the banks have taken $1.7 trillion. So literally, they've only created $300 billion, and that $300 billion is a drop in the bucket compared to the amount of money that's been lost in home mortgages, real estate price declines, the stock market decline, and all the other businesses and bankruptcies that have taken place have been in the multiple trillions of dollars. And so $300 billion is really all the Fed has gotten into the system technically.
So their hope must be that now, with this round of QE, the banks are actually going to be getting the money out there. Is there any hope for that?
Well, the expectation is by saying we're going to do quantitative easing into infinity, that the banks will now be more apt to want to lend this out because they don't expect the punch bowl to be removed. So the Fed's given them all this money, and they were afraid to lend it because they were afraid that sooner or later the Fed would start selling the bonds they bought, and taking the cash back out of the system, the reverse of what they've done.
And then they'd be holding the junk at that point in time.
And they would be holding bonds that are depreciating in value and so forth. And they were afraid of that. That's the theory. It's foolish theory. You know, the problem with the economy is very simple. You're devastating savers.
Right.
You know, like our
punishing
clients.
savers, really.
You're punishing the hell out of them. You know, our clients, you know, some of them would take money and put in CDs and say, you know, I'm quite happy with a 3 or 4% rate of return. We'd say, hey, yeah, great. Well, now they're going out finding that CD is 0.1%.
Yeah.
0.2, and they're saying, I can't do that. I got to try to find a higher yield. And the only way you're going to do that is we say to them, you got to take risk.
Right.
And if you do, I can't promise you what the future's going to hold.
Exactly.
And now they're stymied. There's like, you know, well, how do I get the return that I need to live on? And so you've got this sense of fear that
anxiety,
still grips the market, still grips the consumers who say, well, I don't want to spend that much money because I'm afraid of what tomorrow has to offer, and I don't want to invest too aggressively because I'm afraid what tomorrow has to offer. And then you take that and couple it with all the policy that this administration has put on businesses over the last 4 years. Not to mention the Affordable Care Act, but you have Dodd-Frank. You have another major bill dealing with foreign company activity.
Okay.
You know, and it's hard to explain this, but you know, this one bill for foreign activity is a real job killer. It just, if you understand how the bill operates, it's an incentive for companies to say, hey, I'm not bringing any money back to the United States. I'm going to hire people over in India. I'm going to hire people over in China. There's absolutely no benefit for me to do anything otherwise.
So speaking of which, you're kind of heading into the political territory a little bit. We are in that time frame where you and I are getting a lot of questions from the media and elsewhere. What happens if the election goes this way or that way? And I know you've got a couple pretty strong feelings on this. What happens if the election goes one way or the other?
Politicians are of no importance whatsoever. I mean, if you go back in history, if you're worried about how the stock market's going to do, let's just take that. Actually, you know, Democrats who have implemented some of the worst economic policy. Man, I'm just talking economic policy.
I understand.
I'm not nothing more. Economic policy. Some of the worst economic policy. Markets have done relatively well.
Historically, markets have done better in Democratic.
And it's logical why they would, is because when government spends money, it's just more money into the system, right? More money in the system, more economic activity. The problem is that when government puts money into the system, they put it in very inefficiently. And sooner or later, you get to that place in the future when you hit the brick wall. That's what's happened in Greece. That's what's happened in Italy. That's what's happened in Spain. They're hitting the brick wall. Government has inefficiently used money so many times that they're at the point where the market's starting to say to them, we're just not going to give you anymore. We're not going to give you anymore. So, but in the interim, right now, the United States isn't at that brick wall. Markets are going to care less whether Romney wins or Obama wins. It doesn't really matter. You go back and look at 1980, when Ronald Reagan stepped into office, you had a 2-week rally that he won, and then bam, the market declined for a year and a half, losing 35% while he was implementing some of the best economic policy that our country has ever seen. You know, the market took a 35% shellacking during that period of time. So my point is that, you know, the markets really could care less. Once they start implementing policy, and once that policy starts kicking in, because remember, President Obama put in the Affordable Care Act in 2009 or 2010, I think it was passed, 2010. But it's really not going to start kicking in until next year, 2014. Those are the 2 big years that it starts to really kick into gear. And we'll see what that's going to do. It's going to be interesting.
And very quickly, lastly, fiscal cliff. One of the things that seems to be following election fervor is the anxiety about this potential fiscal cliff, that all these tax changes could happen January 1 and boom, everything's going to go to pot. What are you thinking?
It is a serious concern. The market already knows about it, so
Correct.
the market's already discounted.
Mm-hmm.
And I think they're discounting in the sense that some compromise is going to come up. But we're at a very serious crossroad. We have to stop spending as much money. You can't spend $1.5 trillion more than you have every year.
Yeah,
that's what we're doing.
Yeah.
$1 trillion. I think it's $1.1 trillion this year, and the tax laws are so ridiculous, so out of line. You've got to fix them. They've got to be fixed, and it's going to require a spreading out of taxes in a different way. Right now, there's so much social engineering in the tax laws. It's foolishness. I mean, it's bizarre, to say the least.
And we are going to remain relatively conservative until we get some answers, right?
We're going to stay relatively conservative until the market either gives us a price that we can feel confident to buy at, or we feel that there truly is a better economic response out of Europe and out of the United States. Asia, they're still in fine shape. They're having their problems, but it's nothing more than a typical recession for them. For Europe, it's a depression.
Yep.
For us, who knows what the future holds yet. Anyway, that's the end of our October wrap-up. This is Drew Tignanelli saying God bless.